All right, now we're going to look at variances of standard cost. Variances from standards are determined, it's the difference between what the standard cost should have been for the desk and what the actual costs were, okay? Recall that if we paid too much for the material or labor, or used too much of it, then that's an unfavorable variance. If the opposite is true, that is, we had efficiencies in using material and using in labor, then that variance would be favorable. So we analyze the variances. We analyze direct material, direct labor, and overhead, but particularly material and labor. And we're looking at the variances to see if there's any significant difference between what actually happened and what the standard unit cost should have been for that unit. So we first determine the cost elements that comprise the variance. And then for each cost element, that is material and labor, we calculate the total variance. And that total variance is both price variance and quantity variance. So here we have the relationships, okay? Let's see, and so here the total variance for total direct material is the material price variance plus the quantity variance. For labor, it's the same thing. It's the labor rate times the amount of labor hours we use. Overhead is the controllable overhead versus volume variance. But for us, we're going to concentrate both on material and labor most effectively. Now, when it comes to analyzing the variances, we set up what's called a matrix. Over here in the first column, we take the actual quantity times the actual price for materials. This is material. So the AQ, we use 4,200 pounds, if we will, and we paid $3.10 actual for it. Over here in column number 3, what we do is we set up the standard quantity allowed for the production we did times the standard price. So therefore, for the actual quantity, or the standard quantity was 4,000 pounds, and the standard price was $3. So you see, the standard says we should have made that, the material cost should have been 12,000, but the material costs were 13,020. So down here, follow the arrows down here, 1 minus 3. 13,020 is the actual, 12,000 is the standard. So we have a 1,020 unfavorable variance. Now keep in mind that unfavorable variance is a price variance and a quantity variance. So now, step 2, we have to break out. So we form a middle column here. We take the actual quantity from over here, okay, and we take the standard price from over here. And we say, okay, actual quantity 4,200 times 3. So see what we're doing here is we're freezing the actual quantity and we're actually comparing. The difference in this number here and this number, 12,6, is because of price. Because the standard quantity, the actual quantity is the same in both. So the price variance then is the difference between 13,020 and 12,6. So the price variance is 4,200 unfavorable. Now when you look this way, we are keeping the standard price here the same, but we're comparing the actual quantity versus the standard quantity. So the difference between 12,600 and 12,000 is a quantity variance. That's the difference between 2 and 3. And so therefore, that quantity variance is 600. So you see, 420 of the 1,020 unfavorable total variance, right there, that is a function of a 420 unfavorable price variance and an unfavorable usage variance. So we paid more than we should have, and we used more than we should have. So this would bear looking into. Why did this happen? Now when you set this matrix up, I'll tell you a little secret. You're going from left to right. If left is greater than right, then it's unfavorable. Okay? And in this case, left is greater than right again, it's unfavorable. And when I compare this down here to this, left is greater than right, it's unfavorable. If left is less than right, it is favorable. So now let's look at labor variances. Well, that causes a material variance can be caused by a number of factors. The purchasing department maybe didn't do a good job in purchasing. The production department used too much material. Now we move on to labor. Same matrix again. In the left-hand column, actual hours times the actual rate. We used 2,100 hours and we paid $980. Over here, the standard hours, we should have used 2,000 hours. And we should have paid $10. So the difference between the actual and the standard is down here. It is 580, and left is greater than right, so it's unfavorable. Now keep in mind this is a function of two things. It's a function of price and a function of quantity. So we create this middle column here. We take the actual hours and we compare the actual rate to the standard rate. So the only thing different in these two formulas is the price or rate. So this is a price variance. And the price variance is the difference between 20,580 and 21,000. And notice this is 420 difference, and it's favorable because left is less than right. Over here, the quantity variance, well, we take the 21,000 here and compare it to the 20,000 as standard, and we have 1,000 unfavorable. So you see this 580 unfavorable is masking the fact that we really have a large quantity variance, and that was somewhat offset by a little bit of a price variance. So we should look into why did we use more labor than we should have. And that is what you look at. What caused those things? Did we pay more? Were we not using the labor efficiently? And so on. Now, the last thing is the actual overhead cost. The total overhead variance is the difference between what we actually incurred in overhead and what we applied to the work done. Now, with standard cost, manufacturing overhead is applied based on standard hours allowed for the work. So it gets a little complicated here. But this is just sort of an overview for you. Standard hours allowed are the hours that should have been worked for the units produced. And there's your formula, okay? And the actual overhead is the difference between those two. And we don't really go any further than that to analyze what the overhead variance is. So in this section, just concentrate on direct material and direct labor. And keep in mind that the variance between the actual and standards is a function of both the price and the quantity. Now, once we have these variances, it's very important that we get that information right to the people responsible so they know that if they're spending too much in a certain area. So all variance should be reported, and should be reported quite often. And you see that also leads to the principle that we're talking about here. Management doesn't have the time to manage everything. So what they do is they manage the exception, and variance analysis points to where the exception is. All right, and we concentrate only on those variances that are significant. So there we have it on standard cost variance analysis.